Good evening, everybody. Thanks very much for joining us again. This week, I want to take a look at equity markets. And as we move into the third quarter of the year, I thought it'd be a good opportunity to just take a look at the prospects for global indices and how the technical perspective is beginning to shape up as we enter this new phase. Well, I think what we need to do is really review the first half of the year and to see if this shows us anything for the third quarter, and whether or not we're starting to see signs of momentum beginning to slow, or signs of further upside extension. Now, the way that we're going to do this is look at the current technical conditions for equities. We're going to take a look at price sentiment, looking at any patterns that are building, how the market's been trading, and whether or not that gives us a clue and some sort of focus on what the current sentiment is with markets. And then we'll take a look at some indicators as well to just sort of try and put into perspective how the market's behaving now compared to earlier in the year. And perhaps more importantly, we'll then look at what I think are going to be the important levels that we need to monitor over coming weeks, as to whether or not, if these start to give way, then we can start to see some sort of reaction to what has, let's face it, been a very positive beginning to the year so far, or if we can start to see prices breaking higher for fresh extension. So let's take a look at a couple of markets. We're going to start with the US Tech 100. And just as a review of the year, this is basically from the start of January up to this afternoon's activity just after the US data. So we've caught that for you. Well, I think, summarizing the year so far is that there's been three distinct periods where equity markets, particularly in the US, have enjoyed a very strong period of price strength. And that's been interrupted not by significant sentiment shifts, but more an unwinding of overextended conditions where the market's gone into a corrective phase before we've seen fresh support and we've then re-entered one of these more positive trading themes. And most recently, what we've been seeing is another consolidation correction phase where the market is unwinding upside extremes. And I think this is going to be very important in giving us a clue as to where the risks are beginning to materialize for the third quarter. Now, if we use a very basic analysis of the Bollinger Mid-Average, this allows us to see where the directional risks are. And basically, throughout the year, when we've been above the mid-average, we've been trading in a positive trend, especially if that's then turned up and continued to rise. And when we've broken below the mid-average, we've seen more extended consolidations, corrections beginning to develop. But again, without the moving average really turning aggressively lower or increasing volatility to the downside, it's still been more positive themes that have continued to dominate. And I think the first thing that I really need to point out here is that price action, even though we've dipped back towards the end of last week, beginning of this week, is still closing above the rising Bollinger Mid-Average. And as has been the case throughout the year, this highlights ongoing positive trending conditions. However, we've looked at a positive trending market, which has pretty much been the majority of US indices. When we look to the UK 100 index on a daily basis, again, looking at it for the year, we can see it's been a much more choppy, sideways trading type activity, with the most recent price movement until today's rally being within more negative correction themes. So when we look at the weekly chart of the UK 100 index, it's pretty clear that an important support focus over the coming weeks is going to be this March 23 low at 7196.75. This is important, A, because it's already held within the recent sell-off, but also it represents the last significant correction low of what is a more positive pattern of higher highs and higher lows. So if we start to see this point broken, it may well reflect a more negative shift in sentiment and the potential for a deeper sell-off risk that can see a retracement of the March 2020 to February, March 23 upside moves. And the 38% retracement level stands at 6,750. And that also links with the 2022 lows and clear rejection levels. So this is a pretty strong support. But if we do start to see this level give way, then the risk is that that retracement point may well be the focus over the coming weeks and within Q3. So we have rallied well, but this is still a very important support focus. And when we look to the daily chart, we can see perhaps the important support level still reflected by that March 23 low, 7196.75. But within this rally, as encouraging and as strong as it appears within today's movement, in reaction to the US data, we still have some very significant support resistance levels that I would need to see broken on a closing basis to trigger a more sustained upside move. Because as you can see, even though we are seeing a rally, this is still a pattern of lower highs, lower lows, or a bearish trend. And while we're within that pattern, the risk is for a new failure and a retest of these lows. So my focus to the upside initially will be the 7,477 Bollinger mid-average, which is falling, adding to the significance of the resistance, and then the July 3rd failure high at 75.69. If we are going to see a more sustained recovery during the final half of the year, or certainly within Q3, it would have to be closing this last recovery high within this trend to suggest a more sustained upside move is on the cards. Without it, the risk can see further pressure beginning to build. Okay, so let's go back to the US markets, and we've flipped to the US 500 index now, which is actually very similar to the US tech. So just to give us another perspective on another index. And you can see on the weekly perspective that we are still trading within more positive themes, and that with the mid-average rising, the MACD above zero, and momentum turning up, we're still looking at a more positive trend in place. And this would suggest that risks are back towards the March 22 high at 4,631 or the Jan 22 extreme at 4808. So this is still a positive trend, and the risk is to retest these failure highs. However, my concern of late within the daily picture for both the 500 and the tech sector has been that the latest price highs haven't been confirmed by new upside extremes in both momentum and trending. And this is a concern because it leaves the potential of a bearish double divergence. And even though we have seen today's rally, and we've broken above these recent highs, look at the indicators. They're still below their previous upside extremes. So the risk of this divergence in place is still very much evident. Now, we do need to see confirmation of divergences. And the first point, because as you can see, we've been above this rising Bollinger mid-average for some time, which stands at 4,447, is the first support point. If this divergence risk is going to be developed further, it would be closing breaks below this mid-average. And then we would have to see a break below the last correction low of the bullish trend. So in other words, the level from which the market sold off to, found fresh support, and rallied and made new highs. So if we then start to break below 43.68, then that would reflect a more serious negative sentiment shift potentially, and a deeper sell-off beginning to materialize within the overall structure towards those longer-term retracements. The 38% level would stand at 4,248, the midpoint at 4,170. So yes, today's move is encouraging, and it is potentially seeing breaks to new highs, but just watch these indicators very closely, because the risks are that we are still not confirming the speed of the upside move, the trending condition of the upside move. And technically, that is a worry, especially if we now sell off and break below the mid average and then this last correction low. So I think the conclusion really for Q3 and equity markets in general is that they have recently come back to very important support levels, be it the US indices or even the UK market, which has already seen a significant decline materializing from its recent highs. Momentum and speed of uptrends, certainly within the US, which has seen all of the momentum and all of the positive trending conditions, there are risks of that speed of move beginning to slow. Now, that would have to be developed further, but that potential is still very much in place. And from a technical viewpoint, that has to be a concern. However, when you look at breaks to new highs, if we then start to see the indicators confirming by breaking their latest highs, the divergence will no longer be in place. And that may well open the scope for a more extended and continuation of what is still a bullish trending condition. So as we enter Q3, I think global indices are at a very, very interesting point. They certainly seem to be finding strong support after the US data today, but there are still question marks, still concerns over the sustainability of the move, and we need to watch these lower support levels very closely.